Welcome to Dollar Path, the channel where we transform financial information into clear and achievable steps for your real life. Today, we are going to walk you through the complete path to going from $0 to $1,000 a month in dividends, even if you've never invested before. I'll explain each step simply. What dividends are, how much capital you need, how to start from scratch, which stocks or funds to choose, and how to create a plan that actually works over time. If you want to build passive income safely and sustainably, this video is for you. Let's get started. Most people want to earn money without working anymore, but very few know that there's a real path to achieving it. A path that starts from scratch, with small habits, smart decisions, and a mindset that almost no one has. Today, I am going to show you how ordinary people are going from $0 to $1,000 a month in dividends, and why you can do it too, even if you have nothing today. 1. Understanding dividends. If you're new to investing, you've probably heard the word dividends. But what are they really? And why are so many people talking about them? Dividends are payments a company makes to its shareholders as a way of sharing its profits. Imagine you buy a small share of a company. If that company makes money, it may decide to share a portion of those profits with you. That payment you receive is called a dividend. But the important thing isn't just receiving money, but how you receive it. Dividends can be paid monthly, quarterly, or even annually, depending on the company. And the best part is that you don't need to sell your shares to earn that money. You still own your shares and, at the same time, receive passive income. It's like planting a tree. You plant it once, nurture it, and over time it begins to bear fruit consistently. That's how investing in dividend-paying companies works. Furthermore, when you reinvest those dividends by buying more shares, your profits can grow significantly. Faster, thanks to compound interest. This is what allows many people, over time, to build a stable source of income, regardless of where they live or how much they earn initially. In short, understanding what dividends are is the first step to building financial freedom. It's not about getting rich overnight, but about creating a system where your money works for you, while you continue to progress toward your goals. 2. Calculating how much capital you need. Now that we understand what dividends are, the next step is to answer one of the most common questions. How much capital do I need to live off them, or to generate monthly income? The truth is, there isn't a single figure that works for everyone, but there is a very simple formula. It all comes down to the dividend yield. This percentage tells you how much a company pays in dividends relative to its stock price. For example, if a company has a 4% yield, it means that for every $100 you invest, you receive $4 yearly dividend income. So, if you want to calculate how much capital you need, just do this. Divide your desired annual income by the average return of the companies you want to invest in. Let's say your goal is to earn $1,000 a month, or $12,000 a year. If you choose companies with an average return of 4%, you simply do the math. $12,000 divided by 0.04 equals $300,000. That would be the capital needed to generate your goal with a 4% return. But here's the good news. You don't need all that money from the start. Most investors start small, investing each month and reinvesting the dividends they receive. Over time, thanks to compound interest, the amount grows faster than you imagine. Calculating the necessary capital isn't about being scared of a large number, but about charting a clear course. When you know how much investment you need, you can break down your goal into smaller steps and achievable. In short, it's not about being a millionaire, but about having a plan, being consistent, and understanding how every small contribution brings you closer to financial freedom. 3. Start from $0 with simple habits. Many people think that investing in dividends is only for those who already have a lot of money, but the reality is very different. It is possible to start from scratch, and the secret lies in creating simple habits that you can maintain over time. The first habit is to save a small amount each month. It doesn't matter if it's $5, $10, or $20. The important thing is to build discipline. What seems like little today becomes real capital ready to invest tomorrow. Remember, your progress doesn't depend on the amount, but on consistency. The second habit is to spend intentionally. Start identifying impulsive purchases. Food, extras, unused subscriptions, things you buy on impulse, but not out of necessity. Every dollar you don't spend on something unnecessary is a dollar that can start working for you. The third habit is to constantly educate yourself. Read, watch videos, listen to podcasts about investing and dividends. When you understand how money works, you make better decisions. Investing becomes less intimidating and more logical. The fourth habit is automation. When you can set up automatic contributions to your investment account, this eliminates the temptation to spend that money before it reaches its true purpose. And finally, develop the right mindset, patience, and a long-term vision. You won't see huge changes in a month, but in a year or 5, the difference will be enormous. People who live off dividends today started just like you, with small steps, small investments, and big habits. Starting from scratch isn't a disadvantage. It's an opportunity to build your path from the ground up with discipline and clarity. The most important thing is to take the first step, no matter how small. 4. Choosing quality stocks or funds when you're ready to invest. One of the most important decisions arises. What to buy: individual stocks, mutual funds, dividend, ETFs. The key is to choose quality, not quantity. First, let's talk about quality stocks. These are solid companies with years of stable growth, a good reputation, and business models that work even in tough times. Companies that not only pay dividends but increase them every year. To identify them, look for 3 things: consistent dividend history, low debt levels, growing revenue and earnings. If a company meets these criteria, it's a sign that it can sustain its payouts in the long run. Now, if you don't want to analyze companies one by one, there's a simpler option. Dividend funds, or ETFs. These funds pool many companies into a single package, reducing risk. With a single click, you can invest in dozens or even hundreds of dividend-paying companies. This gives you diversification and stability without having to research each individual stock. Furthermore, funds typically have very low fees and are ideal for beginners. They allow you to build your portfolio without complications. But remember, choosing quality doesn't always mean choosing what pays the highest dividends. Sometimes, a very high return is a red flag. The important thing is to look for companies or funds that pay consistently, securely, and sustainably. In short, choose solid companies or well-managed funds, steer clear of exaggerated returns, and build a portfolio that gives you peace of mind. Because investing in quality not only protects your money, it also builds income that can last a lifetime. 5. Building a diversified portfolio. Once you know how to choose quality stocks or funds, the next fundamental step is building a diversified portfolio. And this is key, because in the world of investing, it's not just about making money. It's also about protecting what you already have. Diversifying means not putting all your money into a single company, a single sector, or a single country. When you spread your investments across different markets, you reduce the risk of a single bad move impacting your entire portfolio. Think of your portfolio like a soccer team. You can't rely on just one player. You need defense, midfield, and attack. Similarly, you need different types of assets to make your investments sound and balanced. The first way to diversify is by sector. For example, holding companies in technology, healthcare, consumer staples, energy, or financials. If one sector has a bad year, the others can offset the losses. The second way is to diversify by country or region. Not all your investments should be in a single market. You can include international companies or funds so your portfolio is solely dependent on one country's economy. The third way is to diversify by asset class. Individual stocks, ETFs, dividend funds, REITs, real estate investment trusts, and even bonds if you're looking for more stability. Each type performs differently over time, and this mix adds strength to your portfolio. And the best part is, you don't need a lot of money to achieve this. With ETFs or diversified funds, you can gain exposure to dozens or even hundreds of companies with a single purchase. In short, a diversified portfolio gives you balance, stability, and long-term growth. It's not about predicting the future, but about being prepared for any scenario. That's the foundation of a smart and profitable portfolio. 6. Increase your contributions over time. One of the most powerful secrets to building real dividend income isn't starting with a lot of money, but increasing your contributions over time. This habit, while seemingly simple, is what sets successful investors apart. Slow-moving investors are not the only ones who truly build wealth. When you're starting out, you might only be able to invest a small amount each month, and that's perfectly fine. The important thing is consistency. But as you gain experience, improve your finances, or increase your income, you can gradually increase that monthly contribution. Imagine starting with $20. After a few months, you raise it to $30. Later, to $50, and then $100. This gradual growth is like accelerating a vehicle. At first, it goes slowly, but then, without realizing it, you're going at a completely different speed. Increasing your contribution also has another benefit. It accelerates compound interest. You're not just reinvesting dividends, you're also adding more of your own capital. This makes your portfolio grow faster and your monthly dividends increase year after year. Furthermore, this habit trains you. It teaches you to manage your money better, prioritize saving, and keep your goals at the heart of your decisions. Every increase, no matter how small, is a clear sign that you're committed to your financial freedom. You don't need to double your contribution immediately. You can increase it a little every 6 months, every year, or every time you receive extra income. The important thing is that your investment evolves with you. In short, increasing your contribution over time is like adding more wood to a campfire. Each new contribution makes the flame grow, and over the years, that campfire becomes a stable source of income that can change your life. 7. Be patient and consistent in the world of dividends. There is a truth that all successful investors know. Patience and consistency are worth more than the amount of money you start with. Because building passive income isn't a race, it's a process. Most people give up because they don't see quick results. They invest for a couple of months, see that the dividends are small, and think, this doesn't work. But the reality is that dividends do work. They just take time. Month. Being patient means understanding that the greatest rewards come after years, not weeks. Your portfolio grows slowly at first, but then, thanks to compound interest and your consistent contributions, it begins to accelerate. That's the moment when many wish they had started much earlier. Consistency is equally important. It's not about investing a large amount all at once, but about doing so month after month, even when the dividends are still small. It's like going to the gym. You don't get in shape in a day. You get in shape by being consistent. There will be months when the market falls and your investments appear lower. That's where patience becomes your best ally. These moments are not a sign to give up, but an opportunity. You buy at lower prices, and your future dividends grow. And in the good months, when the market rises, your consistency pays off. You see your dividends increase, your portfolio strengthen, and your goal get closer and closer. In short, being patient and consistent is the foundation of success with dividends. You don't need to be an expert, nor do you need a lot of money. You need discipline, a long-term vision, and the ability to keep moving forward even when the results aren't yet visible. Because in the end, those who go far aren't those who start the strongest, but those who never stop. 8. Avoid common mistakes when you start investing in dividends. It's normal to make mistakes, but many of them can be avoided if you know what to look for from the beginning. And avoiding them can save you time, money, and frustration. The first common mistake is investing solely for a high dividend. Many people see companies that pay 8%, 10%, or even more, and think it's a great opportunity. But sometimes, a very high dividend is a red flag. The company may be in trouble, its stock may be falling, or that dividend may be unsustainable. The important thing isn't how much it pays, but whether it can continue paying it. The second mistake is not diversifying. Putting all your money into a single company or sector might seem easier, but it's also riskier. If that company's stock falls or that sector goes into crises, your entire portfolio is affected. Diversification is your shield against the unexpected. The third mistake is forgetting to reinvest dividends. Many people receive their dividends and leave them in the account unused. Reinvesting them is what truly accelerates growth. Each additional share you buy pays you more dividends, And this cycle is what builds long-term income. Another very common mistake is selling out of fear. The market goes up and down, and that's normal. But many beginners sell when they see a drop, losing money and ruining their strategy. In long-term investing, composure is an advantage. And finally, a dangerous mistake is not having a plan. Investing without clear objectives, without not knowing how much to contribute or what you're trying to achieve, can lead to impulsive decisions. A simple plan, how much, UI, contribute, what types of companies you're looking for, and why you're investing keeps you grounded even in moments of doubt. In short, avoiding these common mistakes protects you and puts you on the right track. Because in investing, losing less is also gaining more. With discipline, education, and a clear strategy, your dividends can become a powerful tool for your financial freedom. 9. Create a 5 to 10 year plan at this point. You already know how to save, invest, diversify, and avoid common mistakes. Now comes one of the most important steps: creating a 5 to 10 year plan. Because investing in dividends isn't about a month or a year. It's about building your future. A good plan starts with a clear vision. Ask yourself, how much income do I want to generate? In what time frame? And how much can I contribute monthly? These 3 answers become your roadmap. It doesn't have to be perfect, just honest and realistic. Next, break down that big goal into smaller goals. How much you want to invest this year? How many stocks or funds you want to add? How much you expect your dividends to grow? When you turn a dream into concrete steps, it becomes achievable. You also need to decide on your strategy. Will you focus more on dividend growth stocks or on diversified ETFs, or a mix of both? That decision defines what your portfolio will look like in the coming years. And here's the key part: review and adjust. Every year a 5 to 10 year plan isn't rigid. Your life changes, your income changes, the market changes, and your strategy must evolve with you. Perhaps one year you can invest more, another a little less. Or maybe you need to rebalance your portfolio. That's all part of the process. What shouldn't change is the direction. Keep moving toward your goal of building stable passive income. Finally, remember this: a long-term plan isn't meant to pressure you, but to liberate you. It gives you clarity, focus, and a reason to keep going even when progress seems slow. With a 5 to 10 year plan, every contribution and every dividend ceases to be just numbers and becomes a real step toward a calmer, freer life. 10. Mindset for reaching $1,000 a month. Earning $1,000 a month in dividends isn't a matter of luck or finding the perfect stock. It's primarily a matter of mindset. Because before building a portfolio, you must build your way of thinking. The first mindset is a long-term one. Understand that this goal isn't achieved in a few months. It can take years. But every contribution, every reinvestment, and every adjustment brings you one step closer. The right mindset doesn't seek quick results. It seeks solid results. The second mindset is that of an investor, not a speculator. A speculator seeks excitement. An investor seeks stability. You're not here to guess the market. You're here to build an income that works even when the market is volatile. Change that difference. Everything. The third mindset is to see money as a tool, not a source of fear. Many people avoid investing because they fear losing it. But money sitting idle loses value. The right mindset understands that putting money to work is a way to protect and grow what you have. The fourth mindset is one of constant progress. Even if your dividends are small at first, $1, $5, $10 per month. That's where true discipline begins. Those who reach $1,000 a month are the ones who celebrate small steps forward and keep adding to it. The fifth mindset is to always learn. The market changes, companies change, opportunities change. If you keep learning, you'll always make better decisions that bring you closer to your goal. And the final mindset is to believe in the process. Many give up just before their portfolio starts to grow faster. But those who trust the strategy and continue contributing with patience and consistency are the ones who one day open their investment account and see that they are already receiving exactly that $1,000 a month they always dreamed of. In short, Reaching $1,000 a month doesn't start with money. It starts with the right mindset. Because when your mind is ready, your wallet will follow. Thank you for joining me on this journey. If this video helped you understand how to build passive income with dividends, don't forget to like, subscribe, and turn on notifications so you don't miss Path's next videos. Tell me in the comments, how much do you want to earn in dividends per month? And how long would it take you to reach that goal? I'd love to hear from you and help you along the way. See you in the next video. And remember, every dollar you invest today is freedom for your future.